All right, what's up, guys? I hope you're doing well. James here from jamesdforsythe.com, and I wanted to start trying a little bit of a different format for these videos and stuff because I know my internet isn't exactly the best out here, and so sometimes it lags and such, mostly when it's just my face talking and I don't have a screen share or something going, or at least you don't notice it, or that's when you notice it, I should say. So we're going to start doing this. I'm still going over Fed speeches, right? It's just going to be somewhat different. Obviously, there's not going to be no screen share, but I will still put a link to the actual speech itself so that you guys can go and watch it or read it or follow along, whatever you wish to do. But especially if there's no graphs or anything, I don't really see much of a difference. You just can see me move around more, I guess, as I talk. So, but if there's some graphs and stuff, then that'll be up there and everything, and I'll figure something else out. Maybe even have a little bit of, or have a few PowerPoints and such. So with that being said, price stability and kind of the current economic environment. So this is related to a speech given recently, a little less than 2 weeks ago. Took a minute for me to find it, actually. So this was given by Vice Chair Lael Brainard again, and so this was October 10th, 2022, and basically restoring price stability in an uncertain economic environment, right? And so most of it in the beginning is pretty much just kind of her current outlook for the economic environment and where she kind of is with that sort of thing. So to start with, global supply chains have eased significantly, but by some measures they are still more constrained than at nearly any time since the late 1990s. And she ends up citing the GSCPI, or she just puts a link to it basically, but I'm assuming that's what she's used to get that statement. I did I think 2 videos specifically on the GSCPI, one kind of superficially showing you how to use the interactive tool, and another one actually going into what, like, the different shipping indices and stuff that are in there as well. And so you can find those here. I'll try to put a card or something in one of the corners. I think it's that one is where it pops up. But you know, the mirror-like thing for videotaping yourself is kind of still screwing with me. But anyways, the Federal Reserve has tightened policy strongly to bring down inflation, and U.S. tightening is being amplified by concurrent foreign tightening. This is happening all over the world right now, right? And so we are starting to see effects in some areas, but it will take some time for the cumulative tightening to transmit through the economy and to bring inflation down. Uncertainty remains high, and she is paying close attention to the evolution of the outlook as well as global risks. So, thank God for that, right? But regardless, it's one of those things too, and she goes a little bit into this further down into the speech, pretty much about how, it takes time for, especially monetary policy. There is a lag between, when they tighten and like when those will kind of be reflected in like real economic data, not necessarily like kind of financial stuff like the rate on Treasuries per se, or at least the time is significantly lengthened for things in the real economy, right? And I guess you can kind of see this as an example with like mortgage rates on how they've well over doubled since the beginning of this year, but housing prices are kind of just now starting to come down in certain markets. And obviously not a real estate expert. That's mostly just coming from the fact that I'm currently looking for a house and that sort of thing, and just kind of paying attention to where things are where I live. And that's definitely what I've noticed, where interest rates are like in the mid 7s to 8s, and then it's basically just like the housing has barely budged in that respect. But again, I live in Florida, so it is what it is, I guess. So higher interest rates are working to temper demand and bring it into better alignment with supply. This is something they've talked about a few times. I did a specific video on that because I don't remember if it was Brainard or if it was another Fed governor, but one of them did a whole speech on this, and basically just the whole point was to bring demand down to supply, because again, the Fed can't print oil or goods and services and that sort of thing, just bank reserves, right? And even that's kind of superfluous if you really think about it and get into like kind of the euro dollar market and how that whole system works. And bank reserves are essentially pointless, and they don't really work the way people generally think they do, right? And so output has decelerated so far this year by more than anticipated, suggesting that policy tightening is having some effect. So real GDP declined at an annual rate of roughly 1% in the first half, right? Declined. It is negative. It was for the entire first half of the year. 2 consecutive quarters, that whole argument with, like, some people talking about how they're in a recession, and then, what is it, the BLS? Or one of the government entities, I forget which one, came out and was like, we're not in a recession. This whole 2 consecutive quarters of GDP is not really what a recession is, and that sort of thing. And I get it, and there have been some arguments for it that I think are very thought out. I believe, and kind of remember vaguely, I think it was Jeff Snyder talked a bit about how basically, the negative 2 quarters isn't of real GDP isn't a very good kind of indicator for recession, and you have to look at other things. And he gave a really well thought out argument that I obviously need to go through again, because I don't remember the whole thing enough to reiterate it, at least articulate it well. So with that being said, to continue, so recent revisions to national income and product accounts data imply that the current stock of excess savings held by households is lower and has been drawn down more rapidly in recent quarters than had been previously estimated. So basically, the savings in regular households is in their accounts is much lower than they thought it was, right? And I think they even said held by households is about 25% lower than what they thought. I believe that was the revision down. And so this may imply a more subdued pace of consumer spending going forward than it had been projected, right? So it shouldn't be a surprise. That's one thing I noticed, is they put so much weight on the data and stuff, which is good, but it's also like they go through and revise them on a regular basis. And so it's kind of like, how much weight can you put into data that is going to be revised within a quarter or a year or whatever? And so this is kind of this look, it's like they're looking through the rear view mirror in a way, but they have like half of it missing. And it's not like just a complete half, it's like strips are gone and you only have 50% of the mirror to see in general. But at least that's what comes to mind right now. So against the backdrop of slower output growth, we are seeing some tentative signs of rebalancing in the labor market, switching things over. So anecdotal reports suggest the availability and retention of workers are improving, right? And does some job numbers. But the biggest thing I wanted to point out in terms of the labor market is the decline in the job openings to job seekers ratio, right? It declined to 1.7. And so this was I believe it was up in the mid twos. It had a 2 handle for sure. Basically saying that there were more than double openings for people who were actually seeking a job, right? And so that kind of gave the whole, like, there was a major demand for workers, gave them kind of more, I guess, bargaining power in a way. And you also see this reflected in the amount of quit rates, which is still elevated from, I believe, 2019. And so basically people were quitting their jobs for maybe better ones, or just in general because they didn't think they needed one for whatever reason. But this ratio, to kind of put it in perspective, before 2020, it was 1.2. So to put it in perspective to how big of a difference that is, right, from before all of those events that happened in the prior years. Okay, so a little bit more on labor demand. So that said, a variety of indicators suggest labor demand remains strong while labor supply remains below pre-pandemic conditions, right? And so the unemployment rate is now at the very low level that prevailed pre-pandemic. And the volume of quits remains elevated, like I was saying. So this supply-demand imbalance in the labor market is reflected in strong wage growth. The employment cost index increased by an annual rate of 6.3% over the second quarter, and this is its highest level in decades. So at least wage growth is increasing at a significant percent, but it's also like when you backdrop it against the CPI. And the reason why I chose to write this kind of title of what they're not really wanting to say, because they don't really say that. At least with this statistic she does, right? She does say at the very end of her little kind of paragraph in the transcription that it's running below current inflation, right? But it's still negative real wage growth. And that's one thing that I'll get into the very end of this video, because she says something again to where it's like, I don't understand, but you'll understand when I get there, right at the very end. And so it has to do with real yields and that sort of thing. So strong wage growth along with high rental and housing costs means that inflation from core services is expected to ease only slowly from currently elevated levels. So in contrast, core goods have been expected to return to something closer to the pre-pandemic trend of modest disinflation as a result of demand rotation away from goods to services. So coupled with the healing of supply chains and declining core import prices. Excuse me. So a lot of this has to do with the supply chains that we kind of cited beforehand, at least in terms of kind of having a temporary supply shock that you just couldn't get the goods, and that kind of really helped with the goods inflation. And I believe she cites, or maybe it was somewhere else, but basically with goods, it's like they're pretty much always the smallest part of the CPI or something equivalent. May be completely wrong about that, and it's pretty much just in recent years or during when you have supply problems for the most part that this is really kind of a major factor. And a lot of the times this, like currently, this is getting transferred more into services, specifically like with housing and that sort of thing, which I think I misspoke a few videos ago about owner's equivalent rent. It may be 25% of the CPI rather than 33. I thought it was a third. It may just be a quarter, but still a significant percent, right? And that's definitely something that's one of the more sticky components, right? Because it's housing. Nothing moves fast in housing, at least relatively. If you think about like the differences between, like, we'll say the stock market and the real estate market, the amount of time it takes for major corrections to happen is significantly different, right? Even rates, for the most part. So to continue and not try to go down a different rabbit hole, but the return of retail margins to normal levels could meaningfully help reduce inflationary pressures in some consumer goods, considering the gross retail margins are about 30% of total sales overall, right? And so this is something, I'm not really going to place any value judgment on this whatsoever, whether saying it's good or bad, or really put an opinion on it. I haven't done enough study into that specifically to really have an opinion on it, or at least I think. I'm not one of those who has an opinion on everything. It's just kind of, not unless it's something not unless it's something that I have studied in depth and have a coherent argument based on principles, I think, or fundamentals for whatever the dynamic is for that issue. But otherwise, I don't really have an opinion. But it is what it is, and I have noticed that this kind of sway is where she typically goes, and that's probably why she's also kind of a larger proponent of the Fed's Board of Governors for CBDC, which I don't think she actually talks about in this speech, which caught me by surprise, because the CBDC was mentioned in some form or fashion in pretty much every single speech I've ever read from her the past couple years, or not couple years, but since I've been kind of doing this, right? So to continue, let's see. Oh, inflation expectations. Basically, they're expected to move back to the whole 2% target over the medium term now, according to her. So also one of the things she cites with inflation is currently there is a greater dispersion than usual of views about future inflation and survey responses. So previously, this reflected a rise in expectations for significantly above target inflation, but now that dispersion also reflects expectations on the part of 1/4 of respondents that prices are likely to be same or below their current level 5 to 10 years in the future. right? So kind of the longer ends of that kind of curve for inflation expectations are starting to downtrend in a way, at least according to her speech. And then she basically starts going into monetary policy. So balance sheet shrinkage is now proceeding at its maximum rate, reinforcing the move to a restrictive stance. And then also another statistic that she brings up that you really have to think about before, and doesn't actually explicitly state it, but is the inversion of the yield curve, right? And so the 2-year Treasury yield has moved above 4% for the first time since 2007, and the 10-year yield is near its highest level in over a decade at 3.9%. Right, and so the inversion of the 2-year and the 10-year, which is something I've been hearing a lot about recently. I don't know if it's just kind of anecdotal or personal because of the people that I follow and kind of listen to and that sort of thing, but that is something that's been going on. Typically an indicator for recessions, not necessarily, especially the 3-month and the 2-year, or 3-month and the 10-year, sorry, and because that's not how yield curves are supposed to work, right? They're not supposed to be inverted. That's not a good sign. It's kind of an imbalance of demand for whatever respect. And so kind of keeping that in mind. And I believe the 3-year and the 10-year actually inverted last week, sometime recently. I don't remember if it's still inverted or not, but still something to keep in mind. So kind of a final note on the whole tightening and monetary conditions and that sort of thing, right? And so from a global aspect, she says that global tightening is larger than the sum of its parts. And so it's kind of like constricting the whole system rather than, you can't just add basically each country on its own and expect it to be kind of similar. The effect's kind of amplified when there's more countries all doing the same thing, right? And so and kind of a disclaimer that she says, so the Federal Reserve takes into account the spillovers of higher interest rates, a stronger dollar, and weaker demand from foreign economies into the United States, as well as in the reverse direction, right? And so kind of what she means by spillovers is like if the United States is tightening monetary policy by increasing rates, even though it's kind of not really what tightening monetary policy, like tight money is not necessarily like difficult money, I guess. I'm going to come back to that argument at a later time, just because I kind of need to think through it a bit more before I actually start, trying to articulate that, or at least in the nuances of it, right? And so, yeah. Anyways, doesn't mean it's easier to get loans or harder to get loans per se, but basically what they mean by spillovers is that, with tighter monetary conditions in the United States, it can be more difficult for foreign countries to basically send goods here in certain respects, or they won't get as much, right? And so basically you have kind of balance of trade problems within foreign countries, and then those foreign countries kind of start to go down, and then that in turn starts to harm the U.S. and that sort of thing, and vice versa. And this is kind of what I mean by, or what she means by like spillover effects, to where what we're doing here affects the foreign countries to a certain degree that it can come back and bite us as well, right? And so in this environment, a sharp decrease in risk sentiment or other risk event that may be difficult to anticipate could be amplified, especially given fragile liquidity in core financial markets, right? And so it's kind of looking at the trade-offs for this kind of policy in a way. And so at this point, especially when liquidity is kind of in question, it has a habit of amplifying problems in either direction. And so this is where the final statement that I would like to make from her speech really is, she says, that said, the real yield curve is now in solidly positive territory at all, but the very shortest maturities. And basically the entire yield curve will soon move into positive territory with the additional tightening and deceleration in inflation that are expected over the coming quarters. So this is not the first time she said this in a speech. And I think I talked about it in the previous one where she said this as well. Like, I don't understand what she means by yield curve then. She's talking about it being in positive territory. even solidly positive territory, considering the CPI is in the eights, right? And she's even talking about yields being mid fours at the highest, and those aren't even the longer dated maturities, right? And that's what I don't. So she says all but the shortest maturities, and so that makes me think T-bills. But even the T-bills are higher than like the actual Treasury bonds, and so it's like, what? I don't understand how it's not. How the real yield curve minus inflation is solidly positive. Even if you look at PCE, which I know is their preferred metric, it's like that's still, I believe, in the sixes. Core PCE is mid, I want to say 6.3 ish the last time I looked at it, but it's been a minute and don't really want to be cited on that specifically. But even if you look at that, it's still negative, right? And so I don't understand where the whole real yield curve is coming in this respect. So maybe it's not actually talking about T-bills or Treasuries in general. In that case, I'm not really sure what yield curve she's referring to. It just doesn't make sense to me. And so, I don't know. If I'm just missing something in that respect, please point it out in the comments or something, because I honestly don't know. I don't get what she means by yield curve, and if that's not the case. Because I would assume it'd be U.S. Treasuries, but apparently it's not. So, especially with real yields. But anyways, I'm going to leave this one here. So, with that being said, I hope you guys have a good night, and I will see you on the next one.